Hello everyone. In this session, we are going to look at some of the characteristics of the financial market data. So we would be taking some data from the financial markets, typically the monthly values or the monthly closing prices of the various sectoral indices on the Bombay Stock Exchange of India. So I am taking the data right from 2007 onwards till 2016. So January 2007 to December 2016. So approximately 10 years kind of a data. So this is the monthly closing price of each of the I think 10 to 11 sectors is what I have taken, and that would be the data for which I want to analyze the various patterns associated with the data. And regarding what we would be covering, there are four major points as a part of this agenda. First, let's have an understanding of what are the general facts regarding the univariate time series data. So which means single stock or the single index. I am looking at the returns of the stock or the returns of the index. What are the typical characteristics that we see with this financial data? One single variable at a time. And how can we do all those computations on that data to understand the theoretical facts regarding the financial data through various functions of R, and we would also look at executing majority of those things in Excel sheet as well. So let's try to understand both the Excel and the R way of trying to understand the relationship or trying to understand the patterns of the individual variables of the financial time series. Then we move on to our attention towards the multi-variables, the return series, finding out the relationships between the various variables. What do we really understand about the relationship between the multiple variables? We'll try to understand the conceptual aspect or the theory behind what people talk about the relationships between the various variables, and probably let's try to understand from the R and the Excel formulas as well. And finally, once we understood the pattern or the behavior of the data, we'll try to see why we really need to understand all these things from the perspective of implementation for the risk model. So let's try to look at that. And just to give you an idea, whatever I'm talking about as a data set here. This is the data set I'm talking about. This is a monthly data right from January 2007 till December 2016. So this is the data that we are talking of, and I have taken the index values associated with all these sectors, all the 11 sectors: telecom, realty, public sector units, then oil and gas sector, information technology, healthcare sector, finance sector, FMCG, fast moving consumer goods, energy sector, banking sector, and the automobile sector, some of the biggest sectors of the economy. I have taken the index values corresponding to this entire 10-year period, and on that we want to go ahead doing these various activities, understanding the facts as well as testing those facts in Excel as well as in R. Okay, so this is the Excel sheet part of it. When I come to R, this is where my CSV file is present. So I am getting that CSV file into R. So if I quickly look at the data, I can look at the dim of the index, which will give me the dimension. So it's a 120 rows are there and 12 columns are there in this data. Quickly, if I want to check it, I can look at the first few observations by clicking by going with head. Head is giving me the first few observations, so first 6 observations. So this is how the data is at this moment, and at the same time I can even understand the structure of this entire data frame, which tells me that all these are numbers, but this one is actually, it's not a date, it's actually a serial, it's actually a factor with 120 levels. It's looking like a character or the factor. So that's one thing, I need to convert it into a date, right? Or if I have to use it as a time series, I have to convert it as a date. That's something that we are going to look at. But let me first talk about the theoretical aspect. Then I'll come back into Excel and then into R. So let's get started with the understanding aspects. So we'll look at a few facts for the univariate series. So we have to understand all the properties of these series. There's a very important thing, because when I choose a risk model, probably when I have to talk about the value at risk models, or for that matter whether standard deviation is an appropriate model for measuring the risk. So whatever are the various risk models that I am choosing, whether they are appropriate for this data or not, I can really make a conclusion only if I really understand the properties of that data. So having a good understanding of the various properties of the data is very essential for me, right? So there is a very common assumption that the time series data of returns, right, especially the daily returns. Now here we have taken monthly returns, but again the same logic applies even to monthly returns as well. But one of the very common things people think is the returns data is independent. But we have to accept the fact, and it is very strongly proven, that the time series returns, so which means the monthly returns that we are talking of, they are not independent fully. They are not fully independent, and they are not identically distributed. Generally people think that they are IIDs, but what we can say is they are definitely not IIDs. There is some level of correlation that is existing between them, right? So the first thing, if I want, I can check out. First let me do the same in Excel. So if I want to look at the returns for each of these sectors, right, I want to look at the returns for each of these sectors. A simple way I'm looking at here is I'm taking the discrete return. So this minus this divided by, so the P2 minus P1 by P1, that is the discrete return. So I can compute the discrete return for each of the sectors. So I'm doing this computation for all the sectors. So this is the discrete return way. I'll do the continuous return way as well. Right? I'm taking the discrete return. And now quickly, if I want to check the correlation with time period lag 1 for the same set, I want to look at correlations with a lag of 1 month, right? So let me consider here the correlation 1 from here. I will take it till the last but one, and again the other set I'll take with a lag of 1. So I'll not take the first one, I'll take from the second to the last. So first to last but one versus second to last. That's the correlation if I'm taking. That is what is the correlation with a lag of 1. So here it is saying that the correlation is minus 0.11. It's low, but it is not very close to zero that it can be ignored. And if I look at various other sectors as well, reality it is 6, PSU is again 3, looks slightly much lesser in PSU, oil and gas, but in finance it looks much higher, 16, FMCG minus 11, banking is 12.5, automobile is 14. So it's not that the correlation is not existing at all, it can be completely ignored. So that is one point that we are trying to say out here. They are not completely independent also, right? They are not completely independent. There exists some level of autocorrelation with a time lag of 1, but what we generally observe is those correlations are very low, but it can't be ignored kind. Now let's say well, I'll come to the R implementation once I complete this. As I talk about this theory, I'll do the Excel implementation, and we'll do a full-fledged R implementation once we are done with this theoretical as well as the Excel based understanding. So here we are able to show that some level of autocorrelation exists, but it is not that very high. So you find that the autocorrelation values are much lower itself. Then the other important thing, volatility of the return process, it's not constant with respect to time. So if I look at the standard deviations for different periods, the standard deviations are going to be different, right? A simple way, if you want to check, right, though it's not a very effective way to check it, but if we really want to see the standard deviations, let's say year wise, right, I want to find out the standard deviations for different periods of time. So let me take the standard deviations, let's say for 2008. 2008 means probably from row number 14 to row number 25. So let me take the standard deviations for row number 14 to row number 25 for each of the sectors. Right, let me take for this particular sector for 2008 what have been the standard deviations. Right, these are the standard deviations in this particular sector, telecom sector in 2000. So the monthly standard deviation is working out to 11.5%, right? And probably the other sector, reality sector, it went to 24% in 2008. PSU is much lesser, 14%, 12 in oil and gas, 12 again in IT, 11 in healthcare. FMCG has very low standard deviation in 2008. But let me go to 2009 and try out the same formula. Right, let me try out this formula in 2009. Okay, you see here the standard deviation became 13, this became 28, this again is 13, this is 10, much lesser, this is only 7, right? IT's volatility was much lesser. Even healthcare volatility is much lesser. The same goes with FMCG as well, right? But I could see again the banking sector volatility was higher. So this is the story of 2009. But what about 2010? In 2010, the story is completely different. 7, 8, 3, 5. There are hardly any of the sectors which are heavily volatile. So overall, the volatility has come down drastically. But some of the sectors went to their very lowest kind of numbers. Right? This sector was not one of the least. PSU went to much lower levels of volatility in 2010. Now the continuing the same in 2011 the volatility is 7, 11, 4, 5, 6, 4, 7, 4, 5, 7, 7. So again there are different levels of volatility in 2011. The 2012 was showing a different picture, 9, 11, 6, 5. So again the volatilities are different in 2012. Again in 13 also some sectors were much lower. Some sectors have come to 9.5 kind of percentage. So the same logic if you are continuing again in this year, the volatility of the reality sector again has gone up like anything, whereas all other sectors were in slightly a stable kind of a mode. And finally, given 2016 or 2015, again I could see that a few again reality has come back. So almost the volatilities are much lesser. And finally, when I'm looking at for 2016, I could see again reality has gone up a little bit. So the volatilities are not uniform across. That is something that we have seen, though this is not a much better way of doing that task, but I could clearly see that the volatilities are not uniform across the period. We see different layers of volatility across different periods. So the volatility of the returns are not constant with time for any of the sectors. Then it also says absolute or squared returns are highly correlated. Now if I have to compare the correlations, instead of taking the returns as it is, people suggest why not take the absolute or squared returns. Let me take the absolute returns, right? Let me take the absolute returns first, and then let's look at the the correlation. So let me take these as it is. So if I'm talking about absolute returns, I'm simply taking the absolute of this number. That's it. Now when I look at the absolute returns across, these are the absolute returns. Now let me look at the correlations existing between the absolute returns. Right, let me take the absolute returns. These are the absolute returns. I'll ignore the last one here, 1 to last but 1, comma 2 to last. That is what is the one period correlation. So if I look at ignoring the first one, okay, in this case it's not that significant, the absolute. But at least in some cases you could see things are much 25% out here, 10% here, 18%, 16, 20, 15, 19. So in some sectors you find that the absolute values have a high levels of correlation compared to the originals. The same way, instead of absolute, if I had taken the square, again not necessary, but in some cases if I take the square, I may find that the correlations could be much higher. Let me quickly check this by changing it here itself. Once I have taken the squares, I see again the correlations 19 here, 14 here, 27 in case of healthcare, 19 in finance, 16 in banking. So when I am taking the square or when I am taking the absolute, I could clearly see that the correlations are much higher, the autocorrelations are much higher. So when I'm looking at absolute or squared returns, I see that the correlations are much higher, which means I cannot really say that they are all IIDs. I have to knock off the fact that each of the financial market data returns are independent and identically distributed. That is not the case. One, the volatility was different, so that they cannot be having identical distribution. Two, I'm not seeing that they are independent because there is some level of autocorrelation that is existing between them. Then a few more things that come out. The distribution of the financial market returns. There is a theory which says that they are leptokurtic, means their kurtosis values should be higher. So let me test that out. Let's take the skewness as well as kurtosis for this entire period. So I am taking skew of the returns itself, not the absolute returns. I am taking the skewness of the returns. For the telecom sector, it looks like a negative value. So if you look at for almost all the sectors except for a few of them, okay, reality it's a positively skewed. PSU is positively skewed, but oil and gas is negative, IT is negative, healthcare is negative. Majority of the sectors generally they should showcase a negative, but yeah, here we see that some sectors have a positive skewness. But let's look at with respect to kurtosis. Is it really the case that almost all the sectors are showing very high levels of kurtosis value with respect to the returns? Yes, the telecom sector is having a kurtosis of 1.1. 4.8 reality sector is very highly leptokurtic. So is the case with PSU. Right, even oil and gas, IT looks like slightly close to normal, but all the other sectors I see that they are having a kurtosis value which is more than 2, indicating that they are all leptokurtic. So the occurrence of the extreme events, the meaning of leptokurtic being the occurrence of the tails, occurrence of extreme events is more likely compared to what is coming from a normal distribution. Even that is one more kind of a conclusion that we can very well make. So the assumptions of various risk models, assuming that the returns follow a normal distribution, will have a big impact on the model, because the risk management itself is more about the mitigation of the losses, but here we are seeing that compared to normal distribution there are big losses that are possible with respect to the financial returns of various sectors, right? And extreme returns are observed closely in time. So when I'm talking about the extreme returns, if I look at, right, probably let me take the worst 25 percentile return, right? So the smallest 25 percentile return. So because I have 120 data point, I want to check the bottommost 20. If a particular return is there in the bottommost 20, I'll mark it as 1. And if it is not in the bottommost 20, I'll mark it as 0. Okay, so that I want to see where are those bottommost 20s, how close are those bottommost 20s, and this I can take either with the absolute. I'll take with the absolute itself. right? When I take the bottommost 20, I'll take with the absolute. They're all extremes, right? So that's the reason I want to take the topmost 20. So I'll say if this particular value is greater than the 20th largest value in the list, right, or 25th largest or 20th largest, I am looking at just top 20. So if this is in the 20th largest, greater than the 20th largest value, I'll call it as 1, otherwise I'll call it as 0, right? So now if I want to see, I want to see this pattern for all the sectors. Okay, so you could see, yeah, in the reality sector, this is where it's in the top 20. But let's see something. So here, one is here, one is here, one is here. So the telecoms, yeah, both the ones are together. You could see almost all the ones are together out here. Right, again the one is here. One. Now here these are so many days where the zeros are there. So these are nowhere coming closer. But again these two ones are together. So you could clearly see that the extreme values, they generally come together. Again here you see 1 and 1 is out here. Within no gap you have two ones, but again there's a big streak of zeros. So if I am looking at here, there are 19 values that are observed, but again here you see these are three ones that are together. These here you see there are four ones that are together. Here again there are three ones that are together. Here there are four ones together. This is mean if at all the extreme values are there during a particular period, that period can keep continuing. That is what we mean by these kind of clusters. So this is what we are saying. The extreme returns are observed closely in time. Most of the extreme values, they come at one particular point in time, and that is what we are calling as the volatility clustering. And it's very important for me to identify the volatility clusters, right? This is where we cannot use the general standard deviation kind of a mechanism. We may have to rely on the models like DARSH or EWMA, which are volatility specific models. Because volatility is not constant, it keeps changing with time. So I need to have some kind of mechanism which can help me to forecast and predict the volatility so that I can take appropriate risk management decision. And one more important point regarding the univariate time series data is it is found that the empirical distribution of the returns is skewed to the left. To a large extent, for good number of stocks, we have seen that the skewness value is negative, but again for a few sectors we have seen that the skewness is positive as well. But that's the general tendency, that the skewness is very much negative, so which indicates that the negative returns are more likely compared to the positive one. So these are some of the important aspects we need to understand regarding the univariate time series data, and we have very well observed those things when we have taken the Excel data. Now the same behavior I want to look at how to take care of those kind of aspects when I am working with R as well. And when I am working with R, I'll take the help of the F basics package for doing some kind of charting kind of stuff. Right, we'll talk about these packages, and I'll also use the psych package, which is like a psychology based package, but I would be using the describe function from that so that I will get all the various details like skewness, kurtosis, all those calculations in one single shot so that I can make my analysis quite comfortably, right? So this is what is the Excel part. Now we'll move on to execute the same with respect to R. Alright. So now when we start using R out here, the first thing I am looking at here is the month is a factor, but it has to be a date. So let me convert it. Right? How do I convert? I'll overwrite into the same location. Index dollar month. So I'm overwriting it. First, because this is a factor, I'll have to convert it into a character. So I'll say as dot character of index dollar month. So right now it got converted into character, but I want to convert it into a date. So that's the reason I'll write as dot date on the top of it, but I have to give the format, right? We know how to convert it. Format, I will give it in this way. First, initially it is the month, so I'll give it as percentage M, right? It is 1/1/2008. So the first is the day itself, percentage day. Let me just check in the Excel sheet. What is the format? Yes, it's a day, this is the month, and this is the year. So let me do it. Percentage D is indicating the 2-digit date, hyphen, percentage M indicating the 2-digit month, and percentage capital Y indicating a 4-digit year. So this is the format of the date. So based on this, I'm converting it. Now let me just quickly check what is the head associated with index. Now I see that it got converted into an R understandable date. So I see 2007-0101. This is year hyphen month hyphen date. Even if I am looking at the tail, which is the end data, I am seeing 2016-7-1. So we have got the date in the right format. If we really want, we can look at the structure of the index as well, which says that it is a valid date format. But now, right now that it's a valid date format, now let me look at doing a few things. I have got the okay, now I don't have the returns data. I have the stock prices or the closing index prices or the index values is what I have. I don't have the index returns. So first I need to get the returns from the index values, right? So overall, either I can convert that into a time series kind of a data, or I can very well convert it into a zoo kind of an object. So I can convert them into different kinds of objects, either as a time series or a zoo. So let me look at the if I'm talking of time series. So let me talk about time series as an object. Okay, so I need to load F basics first of all, right? So let me load the F basics. I've loaded the basics where even the time series package also will be inserted. So I've loaded the basics package, and from there I'm getting the time series package. So within that time series package, let me quickly look out for the time series function as well. Okay, so you see the time series class, it's a function to generate and modify the time series objects. Right, so this is what I'm going to do, the time series. I have to give the data, and for that data I have to specify what is my character vector. Character vector of dates and times, or any object which can be coerced to a time date object. So this is what I'll identify as my char vector. So this is where I'll start index dates, right? I'm converting it as index ts. Let me call it as index into a time series format. So I will convert it as a time series object, wherein the data I am taking it is the simple index data. So I'll take the index data as it is, and I will take the character vector char vec. I will consider the first column, which is the month column, because here character vector of the dates and time. So I'll look at the month column. No, month column will not do the job. I'll say index $month, because it's a vector that it is expecting. So I have this data. So yes. So if I look at index ts now, which has become a time series object, right? So we have got the character vector of this. Probably I don't need this column altogether. So what I'll do is I'll omit this column, index ts. I'll say index ts of all the rows. I'll take a subset. I don't want the first column, so I'll take that. So based on that, now I'm looking at index ts. Yes, this is working out in this way. I got the dates out here. So these are my index values now, and I see these are my sectors, and for them I have the values. Now I can very well find out the returns as well. So I'll say index returns. I'll compute the index returns, where I'll take the difference. I'll take the difference of the logarithms of, right, let me look at this one. I'll take the difference of the logarithms. I'll take the continuous return. So I'm taking the difference of the logarithms of index ts, because I'm interested in the continuous, and if required I will multiply it by 100. So this is what I'm calling as index returns. Now there is a problem, because it is coming out as diff. Okay, so first let me take, in case of time series, let me see if I can directly use the returns function, compute the financial returns from prices or indices. Yes, I should try this. So anyhow, X is an object of the class time series. So let me just check index TS. Is it a time series class? It should be. Yes, it's a time series. So what I'll do is index ret. Here I will compute simply the returns of index TS. I'll compute the returns, and on that returns I'll multiply it with 100. So I'm considering the returns out here directly for the entire index. So let me just quickly check head of index ret, which is computing the index returns. Or let me look at the index ret directly. What has happened? Returns X. So I have to do for each column, because my X here is for one single, it's an object of the class time series. Index ret dollar telecom. Let me just see that. Or index ret index ts dollar telecom. No, this does not come into picture. So let me reinitiate the process. Right, we had index. Let me take the head of index to relook at it. So this is what we had as the index, right? And structure of index, it's a data frame, so the month is a date. So what I will do is I'll create another variable called index1, where I will take out the first column of the index. So only with the remaining columns I want to create another variable called index1. So which means now if you look at index1, it will contain only this particular data. That's it. So the table is typically gone off. Now this one I will convert it into a time series directly rather than converting the whole. That is where I think earlier I have landed up into a problem. So now I will convert only this data into time series rather than having the original the date column as well. So this, let me try this time, index ts, wherein I would like to convert this into a time series. So index 1 I want to convert it into a time series, where I will give character vector. Let me give it from index dollar month. I'll give this from index dollar month, so that so this is how I have to give the time series. It should contain those columns which should not include the month column. So either I should have given it as index, all the rows, I should have taken the subset of index itself rather than index 1, which is like index of all the rows and minus 1 column. Character vector I could have taken directly as index dollar month. Now this should give me, if I'm looking at index TS, it should give me the same way which we had earlier, but this would be a much better. Earlier we have created it along with the month, and after that we have removed that column. But let me try this way. When I'm creating the time series itself, I'm creating it without the month column, and then character vector wise I'm giving the column that is containing the dates, right? So let's try from here. So now let me try the returns, right? So let me use this function called index ret, which is actually performing the returns on this time series data. So let me compute the returns with respect to index TS. So let me compute this time the head associated with index ret to see if it is working well. Yes, now I have got it. So I'm getting the returns associated with each one of them, right? So these are the returns for each of the time series. And I have the column names that are associated with the corresponding sectors itself. Now, if required, I can actually do the series plots for each of these returns. So for that, I can take the help of series plot, and I can very well do the series plot associated with index ret. But of course, when I do like this, it's like I'm plotting for all of them. So I could clearly see. So this is for the auto sector. This is what are the series returns. I could see some kinds of up and down kind of stuff. So this is what is typically coming out as a part of the monthly returns. So you see some kind of mean reversion kind of stuff with respect to auto. Now the same way, if I go ahead, I could see with all of them. So let me close this. Otherwise, let me try for one at a time. So index ret, let me take it as uh, index ret dollar telecom. No. Or I should typically do it as a multiple one. So what I can very well think of here is, let me do a par MF row C, because I have 11 sectors. Let me set it as 4 comma 3, 4 rows 3 columns, right? So once I set this, so this is the kind of a graph that I am setting out here, and based on this I can think of doing the series plot of all of them. So now this is how I am getting the series plots of all of them. For the telecom, again I could see things are up and down. The reality sector is again like this, the PSU is like this, the healthcare. So now I could see for almost all the sectors, this is how the finance, this is the FMCG. So this is how we could see the series monthly returns. In some cases they are going up, some cases they are going down. So more or less similar kind of patterns across all the series. Similarly, for the same, if I want to look at the box plot to see the outliers kind of stuff, I could typically go with a box plot. for the same index returns. I will look at the box plot. I could see here in this case, okay, in telecom we have a lot of values on the negative side, indicating negative skewness. Reality we have a couple of them this side, but in majority of them PR, PSU we are seeing some kind of negative outliers, oil and gas, negative outliers, IT something in the negative, health more in the negative. Even in finance, we have a few negative returns, banking, a few negative returns. So, overall, it is looking like the box plot is telling me that there is a possibility of some level of negative values that are coming up. But most importantly, I want to look at the autocorrelation function, for which I am looking at ACF, and this I can look at with index red. I could see for all the lags, so these are the different autocorrelations that are getting computed. So if you see, these are the different autocorrelations that are computed. For series 7, series 8 and series 9, series 7 and series 8, across you could see that the autocorrelation values across the different lags, you don't see any significant spike. Only at 0 we are seeing some significant spikes coming up, but nowhere else, which is an indicator that the autocorrelation values across the series are more or less smaller. That is what you could see here. Only the spike is there at 0, because obviously at 0 the correlation is going to be 1, but everywhere else. Okay, let me reopen the R. Something went wrong in terms of the execution speed. No, I have to reload the stuff again. So let me quickly reload it and get it back. So here I can very well look at the ACF. Right, if I am looking at the ACF, the other way of looking at is if I am typing for ACF, auto and cross covariance and correlation function. So it computes the and by default plots. So I will look at the computation estimate of the autocovariance of the autocorrelation itself. So what I can very well look at is ACF. I'll take the X and I'll say by default, because the plot is true, I will set the plot to false. So that way that complex graph plotting would be avoided altogether. So I'll simply try out saying ACF of index TS or index ret. I'm looking at ACF of index returns, where I can take it either for correlation or the covariance. Probably let me take type equal to correlation, because I can do the I can get the ACF both with respect to correlation or even the covariance or even partial. By default the plot is true, so let me set plot to false so that I'll get the values. So this is much better for me to understand, because of so many complicated series our graph was looking pretty much problematic. So this is where if it had been one single series it would have been more comfortable. Now with series 1, which is the telecom sector, I could see that this is how the autocorrelation has been. right? For the series 1, I could see that the autocorrelation is almost negligible, right? 0.11, 0.06, 0.03, so hardly any kind of autocorrelation. This is what we got even through the Excel sheet. The series 2 is talking about a reality sector. Again, we are looking at more or less similar kind of stuff. Then the series 3, series 4, for across the series, we are seeing that the correlation values are much lesser. Right, we are talking about auto correlation with respect to lag. So lag 1, lag 2 kind of stuff across the series. Now the same logic is going out here for each one of them. So wherein you don't see at any point any kind of significant autocorrelations that are existing across. So that's one reason we can directly say that the correlations are much lesser. But at the same time, when I'm going with partial autocorrelation function, right? Again, the default is true, so I can still go with partial autocorrelation function where I am taking the index return, but plot I can still make it false. So even in this case, I could see that there are 11 different series, but in the partial autocorrelation, okay, if I go with a graph, what is it coming out? At least for the last one we could see. So these are the partial autocorrelation functions that are coming up, wherein you could see that for some kind of lags, we are seeing some spikes coming up, which is an indication that there is some level of relationship that is existing, which can't be completely ignored altogether, right? If you look at the different time periods, I cannot ignore. You could see the kind of plots that are coming up where we clearly see that it is crossing the kind of line which is indicating that the partial autocorrelation is very much possible. But the same logic I can do with respect to absolute returns. So I can say index ret absolute, wherein I am simply taking the absolute of the index returns, right? This I should have done with only one single security. That would have simplified the overall understanding, right? If you do it with only one single security, that will simplify the overall understanding as well. So now I have done the index ret absolute, wherein I am, if I look at the head of it, it will give me the absolute values of the returns only, no negatives, no positive. I mean, everything is converted into positive. Now I can very well look at the ACF associated with this, which will give me the autocorrelation function. So for the index ret, I can take the autocorrelation function with a plot. This time let me make it as false. So again, for different series, if you see, so this is how the autocorrelations are going. So we could clearly see now the index. Oh, I have to take it per index ret apps. Now let me try looking at it. So this is how the correlation is moving, 0.11, 0.11, some kind of correlations started existing. If you look at it with respect to series 2 out here, there is a 27, 24, 30. For 4 period lag, it is around 25. For a 5 period lag, it is around 22. So for reality sector, we see that the correlations are much higher. Similarly, look out for series 3, 10, 10, 6, 10, 19, 12. This is how the correlations have been. For the fourth series again 16, and somewhere there are 26, 29, 23 kind of numbers. Then similarly for the fifth series also we see some 23s and 22s, which means the autocorrelation clearly exists with respect to the absolute return, but it is typically not present with respect to the regular returns, taking the positives and negatives into consideration. The same logic I can apply for going ahead with QQ norm plots as well for each one. So let me set par MF row equal to C4 comma 3 so that I can look at all of them in one single shot, wherein I'll go with QQ norm plots trying to understand what is the level of normality that each of these returns are typically following. So let me take it with the index ret itself. I don't need absolute here, right? Or let me make the par 1 comma 1 itself. QQ plot index ret. So I could see for each of the sectors to what extent they are coming closer and closer to the normality. So if I take only one column, it would simplify the entire graphing process, because otherwise the graphs are looking quite absurd, wherein all of them are getting plotted into one single itself. So probably I could have taken index telecom as index ret of only the first column. If I take like this, index telecom, if I take it only as the index ret of this, then let me try QQ norm plot for index telecom, index T. So now you could see that this is coming exclusively for the telecom itself, where I see so many values are deviating from normality out here, which is a clear indication that there is lots and lots of left skewed or the negative skew that is present as a part of the data. So the same logic if I go with from index ret, if I start looking at for each of the columns separately, let's say for the second column if I look at it, so this is how the reality is coming out. You see some kind of deviations from normality out here. The same logic I can take for the third, which is the next sector. So for each of the sectors I could see how the deviation from the normality is coming up. Probably the ACFs also, I want to try it this way, right? If it works out, then I think for each ACF we could see very clearly. So even if I take plot equal to true, yeah, this is looking like a much better ACF for each of the columns. This is for for the telecom sector. This is for the reality sector. Probably at 0 only it is looking like spike, but at all other places it is at somewhere with a lag of 5, or probably 1, 2, 3, 4, 5, 6, with a lag of around 6, we see that there is some kind of a spike showing some kind of a negative correlation, but that might be very much purely because of charts. Similarly, for each of the sectors, I can very well look at this. It's very much lying within the limits itself. But if I look at it with respect to the absolute, it might very well be the case that for some of them, it is slightly above the cutoff limits. If I look at it with respect to reality sector, yes, I could see that there are so many spikes that are above the cutoff line, indicating a presence of high autocorrelations, significant autocorrelations in the reality sector. Similarly, I can very well take the PACFs also to really understand what is the level of partial autocorrelation. You could see that they are, in case of absolute, they are very much significant and they are gradually draining off. Whereas if you look at with respect to the telecom sector, none of them is significant. So there are differences in the way the partial autocorrelation functions are present for each of the sectors. Now, so with this, it's very much clear that there there exists all these rules that we have discussed theoretically. So we are able to check all these things. We have converted everything into a time series object, and based on that we have looked at the plots of the series plot, box plot, ACF, PACF, absolute and squared returns. I can very well take and do the same activity. I can also go ahead with the volatility clustering. I can actually plot, right, only those days where the value is greater than the 20th minimum kind of stuff, right? Just like the way I have done in an Excel sheet, I can very well do the same thing in R, and based on that I can showcase the kind of presence of volatility clustering in the data. We have looked at the normality plot of the returns. Based on that, we are able to say that the data is not normal. But at the same time, I can also check for normality using the psych package, where I can use the describe function. Right, probably let me look at the describe function for the index returns, which can show me the skewness and the kurtosis levels. Obviously, it looks like the kurtosis is much higher for all the sectors except for IT, which is around 0.77. But otherwise, they are all more than 1, indicating a leptokurtic again. Even the skewness wise, for a good number of sectors, the number is negative. Telecom, oil and gas, IT, healthcare, right? FMCG, energy, auto, for all these sectors it is negative. But for some sectors it is positive, but that number also you could see is very much around 0 itself, not significantly higher. So the overall tilting is more towards the negative rather than towards the positive, indicating the presence of negative skewness in the data also altogether. Now, whatever the properties that we have observed till now, they are nothing specific only to stock markets and the stock prices or the index prices alone. Almost all the other asset classes like bonds, currencies, commodities, futures, all these kinds of stuff, they exhibit more or less the similar relationships itself. So we need to understand the patterns of the univariate data so that we can take care of the risk management aspects of the data appropriately. Right? Now, just extending it to the multivariate returns, we could see we can actually take the cross correlation between the returns. So if I'm taking the absolute value of the cross correlation between the returns, let's say for each of the securities, right? If I really want to evaluate that part, I'll take the CCF, where I'm going ahead with the cross correlation function between index red, uh, the first column, versus the index red, the second column. If I am taking these kind of cross correlations across between these two, okay, CCF is associated with the univariate time series only. Let me just check the CCF. Here it is taking only for univariate time series. Let me try converting the index TS or index ret directly as, let me convert it to as dot zoo, right, index ret, so that I'm converting it into a zoo object and see if okay, I have to load the zoo package. Once I have loaded it, I want to convert the index ret from the time series to a zoo object. But in this zoo, let me see if I can use the CCF. CCF is actually coming out with X and Y, a univariate or a multivariate numeric time series object of an ACF. So let me try if I can directly use ACF itself. ACF of index ret 1 and index ret 2. If I look at this ACF, okay, but let me again convert it back to the time series object itself. So if I look at index ret now, this is what is coming out. Right, so this is what is coming out. So what I can typically look at is I will try the ACF function directly with the two variables. Yeah, looks like now if I'm looking at the ACF function between the two variables, yeah, so this is giving me across the period at time lag 0. This is what is coming out for the first one. I would like to find out the correlation. I'll try to directly look at the correlation between the index returns across. So this is how the correlation between the various index returns are going to come out. I could see that telecom versus reality, the correlation is around 0.66, telecom versus PSU, it's around 0.65 correlation, 0.63. So there is some level of good correlation. Oil and gas versus reality, there is a correlation of 0.8. So some sector returns are very highly positively correlated, whereas for some sectors the returns are not that correlated. But for each of the combinations, we could see that the correlations are much higher, right? And if I go back to the data, if I'm looking at cross correlation between the return series, the absolute values might be much lesser. But if I'm doing it with respect to the absolute returns, so let me take the absolute returns and try finding out the correlations across. We could see that in this case these are much lesser pronounced compared to the original correlation, but typically we might observe, whereas in some cases that's the case. PSU versus oil and gas, almost 81% correlation here, whereas PSU and oil and gas here it is 88. So here it is looking like in the normal terms itself the correlations are much higher compared to the absolute values, but that's a typical trend that we see with the multivariate time series. And in some cases I can even look out for the rollover kind of correlations as well. When I'm saying the rollovers, I'm actually going with the across the period and seeing to what extent across the period the correlations are typically changing. If I have to showcase the same in an Excel sheet, so these are the numbers, right? So let me hide all these things to start with. Now here, if I have to talk about the rollover correlation, I'll start somewhere here, right? And I simply talk about the correlation with some kind of a time lag, right? So I'll start right from here. So this is one data that I am taking, and I'll omit one and I'll go till the next one. So one period lag itself, but now this I am rolling it over. So here initially this is the kind of correlation, right? Across all the sectors we are looking at this correlation. Now we are rolling it over till the last. The same logic, we are rolling it over till the last. What you could see here, this is a period when there is a correlation is literally not existing. Autocorrelation does not exist. Whereas the same logic, if I am going even down, the autocorrelation started existing. So that's one kind of a dimension that we can talk of. Then the second dimension that I want to look at is, once I hide this off, again let me start somewhere here, somewhere let's say in the 50th row. Let me talk about the correlation between some pairs, right? All of them again we are not showcasing. Let's say I'm going with two sectors at a time. So let me take telecom and reality, though I can do for all the pairs rolling it over. So here it is 0.76 between the two sectors, and probably if I go with, I'll get the correlations across the sectors as well. But now if you extend it, so you see here it is 76, 75, 74, 72, 68, 67, 50s. Again it has gone to 60, 40s, 48, 44, 42, 38. So right from a period of 70s and 80s, the correlation has come down to 30s between the telecom and reality. Whereas between the reality and the PSU, 89, 90, 89, 90, somewhere it became 80, but it has been maintaining between 80 and 90 itself. So between different sectors, we see that the correlations of the returns are changing with time. So that is what we are calling as a rolling over. Now in R, if I have to observe that kind of a rollover correlation, I really need to write some kind of a function. I'll write it as roll C, where I am talking about the rolling over of correlation. So I'll write a simple function saying the number of dimensions that I would be taking here is the number of columns of X, that is the number of dimensions that I would be taking, and here the rollover correlation, I'll use the function called so for computing this rollover correlation, I'm taking the correlation of X itself. I'll take the correlation which we have computed above, but within this correlation I'll take only the lower triangle. So I'll call it as, I'll not take all these values, I'll only consider lower dot try, and across the diagonal I am taking the dimension. So the dimension is the number of columns, which is 11. So I am taking for all the diagonals across, I am taking only the lower triangle associated with them. So which means all the values that are there under the lower triangle are typically considered as a part of my correlation, and the diagonals I am typically setting them to false. So that's the kind of, I mean, I'm computing the overall correlation, but within that, across the diagonal, I'm not considering the diagonal, but only the lower part of the triangle is what I'm taking, which means these are the different values that I'm considering. Only these values would be considered as a part of the rollover correlation. So this is what would be finally returned for. I'm returning all the rollover correlation values. So this is where my function is ending. So I'll get all these. If there are 11 sectors, I'm getting 11C2. Around 55 correlations are typically coming out. So now I'll do the rollover of all these 55. So I'm simply creating a function called rcor, where I will use what is called as a roll apply function. So you can very well look at this roll apply function, a very interesting function which is there in Zoo. A generic function for applying a function to the rolling margins of an array. So that's the major thing. So I just need to give a function which need to be rolled over. I have already created this function called roll C. I want this to be rolled over altogether. So this is what I say. I'll create a RCOR, which is like a rolling correlation, where I would be applying, or I'll do a roll apply, where I would consider the index returns itself. So I'll consider the index red. This is what is the value that I would consider. I have to specify what is the width for the roll, right? Because here the width is the numeric vector or the list. So that's something that I have to specify. This is an integer specifying the window width, number of observations. So because this is just a 10-year kind of a data, 120. So let me roll it over with 30 or 40. So I'll say the width is around 40, and I'll use the roll C as the name of the function. So this is what I'm getting as a part of error in correlation of X. Index red. So the role apply the data to be used representing a series of observations, that is what we have used. Okay, the whole width I have taken across the entire 120 observation. So that's the total number of observations we have. So now if I am looking at R core, so it's a data frame with 0 rows and 0 columns. So what has happened? Roll over, roll apply, index red. What is the index red right now? What is the class of index red? It's a time series. The roll apply is actually there as a part of the zoo. This is what is the problem. So I have to convert this into zoo again. So I can say index red zoo as dot zoo index red. So I have to convert it to a zoo. So now let me check the class of index red z. Now this is of the class zoo. Now let me try if I can do an arcor where I am doing a roll apply. I have to give the width, and when I am looking at arcor it's not able to apply. But yes, this the one which we have looked at in Excel, we can try the same in R as well. Something has gone wrong in the process, the overall. So you can try right from the beginning, creating it as a zoo object, and based on that, going ahead in terms of using this role apply kind of a function on the index red Z. Let me try this. Arc or role apply index red Z, and if I am going with 40, it's not coming. There's some kind of a problem that is working out with the rolled over correlation. We can try this out, but these are the typical functions that can help us in terms of assessing the rolled over correlation. That's the same thing with respect to Excel, whatever I have executed. That's the typical concept. We see that the correlation keeps changing with time, and that's the major thing that we are talking of out here. So the final implications wise for the various risk models, what we are more concerned of is the risk models which assume that the processes are independent and identically distributed for the losses. They are not adequate because there is a lot of dependency between the variables, and and even the distributions are not identical because we see that the correlations are different, we see that the variances are different, all values are different across the time. And the risk models, if they are if they are based on the normal distribution of the data, then they would not be adequate in predicting the extreme losses because most of the times we have seen that our data, that our returns were following a negative skew, which is a clear indication that negative returns are much more probable compared to positive returns. And we are also seeing that the kurtosis is much higher, which means the extreme values have much more possibility of occurring compared to a normal. So if my risk model is based on a normal distribution, then it would fall short in terms of prediction. Even the volatility regimes should be taken care of by the models, because the volatility keeps changing with time. So we cannot have the model where the volatility can be taken as constant across. So all the risk measures that are getting designed, they should be changing, they should be adapting to the changing environments. So when the volatility is lower, the measure should be different, and if the volatility is higher, the measure should be different. And in the portfolio context, the model employed should be flexible enough, wherein even the correlations between the assets also should keep changing with time. So all these things should be taken into consideration while building risk models. So that's where the understanding of the characteristics of the financial data, both univariate as well as multivariate, is very essential for us. And when we are talking of all these characteristics or the facts that I have identified, we have to keep those in mind, that for majority of the asset classes, not necessary for stocks, we see these kind of behaviors in the data more and more frequently. And all these behaviors need to be understood well, so that appropriate risk models can very well be chosen and be applied to the data. So this is what I wanted to cover as a part of this session. If you have any further queries, you can very well get back to me by giving me a call on the number that I have given below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.